Okay, so we have a question here. The following financial information relates to NIC Limited. Investment in 9% redeemable debentures, 1 million. Ordinary share capital per value, 0.8 million. Average annual profits after taxation, 0.2 million. Proposed dividend payout ratio, 40%. This dividend payout ratio, it just tells you from your profit, 40% of that is going to go to paying out dividends. Then annual dividend payout ratio 4 years ago, 30%. So 4 years ago, from their profit, 30% was was used to pay for the dividends. Equity beta 1.82. Equity beta just measures the riskiness of shares. Any equity beta above 1 means shares are risky. There's a high risk. You can make a lot of money or you can lose a lot of money. Any equity beta less than 1 means it's less risky. Okay. And the name of the game is the higher the risk, the higher the returns. So if you see shares with higher equity betas, expect high returns from those companies. Okay. If you see shares with low equity betas, expect lower returns. Okay. So the debenture interest is paid semi-annually, and the debentures have 5 years remaining to maturity. The debentures have a par value of 1,000 kwacha each. The average market risk premium is 6%, and the average sector price earnings ratio is 12. Okay, price to earnings ratio is just a comparison of what you're paying for a share to how much you earn for that share. Okay, so if you see a price earnings ratio is 12, it means you're paying 12 kwacha for that share to earn a 1 kwacha. Okay, colleagues? That's what the price to earnings ratio is. It's just how much you're paying for a share. This is how much you earn from that share. Because remember, the shares give you dividends. Yes. Investors in debentures require a return of 10%. The risk-free rate of return is 4%, and the average sector price earnings ratio is 15. The debentures will be redeemable at par on maturity date. So estimate the value of NIC Limited using the following methods. Now, last time we already did this one, the present value of future cash flows generated from the debentures. So today we'll look here at the price earnings ratio method and the dividend growth module. Okay. So with the price earnings method, this is the easiest, all right? Because for the price earnings method, it's just your profit. Oh, let me use Word. Or we can still go through these solutions here, which I already did here. Okay. Yes. It's just the profit times the PE ratio. Okay. The PE ratio for the sector. Okay. That's your profit. Okay. Your net profit basically, or your profit after tax, times the PE ratio for the sector. Okay. So in our question, they told us our average annual profits after taxation is 0.2 million, which is the same as 200,000. Just multiply 0.2 times 1 million and you get 200,000. All right. So the value of Trimble Limited using this method. So multiply this 200,000, which is the profit, times the average sector price earnings ratio, which is 15. So 200,000 times 15 gives us 3 million. Okay. So that is the value of this company. Okay. The value of this company based on its equity. Okay. 3 million. Any questions? Wonderful, wonderful. Now, colleagues, there were two. Okay, there are two PE ratios. So the best was to use the most recent one. Okay, that's why we use the 15. Okay. All right. Now we're going to use the dividend valuation growth model to get the value of the company. Okay. So the dividend valuation growth model. This is the formula. Okay. Basically, price of the shares. PO just represents the price of the shares. DO represents the current dividend that has been paid for the shares. 1 plus the growth rate over the cost of equity minus the growth rate. All right. So with this question, we haven't been given the growth rate. All right. Even the cost of equity, we need to tabulate the cost of equity. All right. So first things first, we need to get the growth rate. Okay. So the growth rate, you can get it like this. The growth rate, which is G, okay, you can put the recent growth rate. So we put R2. So here, the rates that we're going to use are the dividend payout ratios. Okay. The rate of the dividend payout ratios. So we said, so we can put dividend payout ratio 2 over the dividend payout ratio 1 to the power 1 over n minus 1. Or what you can do is you can say growth rate equals the current dividends that have been paid current dividends paid over the previous dividends that have been paid 1 to the power 1 to the power 1 over n minus 1. Okay. So either way you get the same. So if you use the rates, remember the dividend payout ratio, the first one is 40%. 40% over 30%. Okay, these are the dividend payout ratios that I'm using here. Since they said the first we have one dividend payout ratio which is the current one which is 40%, then we have one that was paid 4 years ago. So this n here we're going to use 4 years to the 1 over 4 since they are 4 years apart. Subtract from 1. Okay. If we use this method, just make space. Let's get our calculators. So 0.4 over 0.3 to the power. So 1 over 4, you can just put to the power 0.25. Okay. To make life easy. To the power 0.25 minus 1. So let's get our calculator. 0.4 divided by 0.3. Yes, 1.33. So 1.33 to the power 0.25. 1.0738. So we can just put it as 1.074 minus 1, we get 0.074, which translates to a growth rate of 7.4%. So this is the growth rate here. That is one way you can find it. Okay. The other way, okay, you can use the actual dividends. Okay. They told us our dividend payout ratio, our current dividend payout ratio is 40%. So when find out, okay, so how much is the profit, so that we find out how much the dividends are paid. We've been told the profit is 200,000. Okay, so you say to get your dividends, you can just say dividends are to be paid 40% of 200,000. What is 40% of 200,000? 40% of 200,000? 8. Yes, 80,000. Remember, all we're just doing is we're trying to find the growth rate, okay, so that we can put in our formula, so that we can find the value of this company, okay. So then we also calculate the dividend for 4 years ago, which is 30%. So you say, what is 30% of 200,000? It's 60,000, yes. So here in our formula here, current dividends 80,000 divided by the previous dividend of 60,000 to the power 1 over 4. What is 80,000 divided by 60,000? Yes, 1.33 to the power 0.25. Yes. And you eventually end up to 7.4%. Any questions? Before I show the third way of getting this. Okay. There are actually three ways of getting it. Okay, we use the first one where we use, okay, the dividend payout ratios, the current payout ratio divided by the old payout ratio to the power 1 over 4. Or the other way we've used, we get the current dividends that have been paid, which we've tabulated from the payout ratio. Okay, for the current year and 4 years ago, and you see, we'll still get the same answer. Right? The other way you can do it, okay, you can use this formula here. Okay, your expected dividend equals the previous dividend multiplied by 1 plus g to the power 4. Okay. Basically, what this is telling us is that this dividend of 60,000 here, let me just admit someone. Okay, this dividend of 60,000 When you multiply it by the growth rate, okay, since 4 years have passed, that's why I put it to the power 4. When you multiply it by the growth rate, it's supposed to give you 80,000. Okay. The dividend for 4 years ago, when you multiply it with the growth rate to the power of number of years that have passed, you're supposed to get 80,000. Okay, then it's just a matter of algebra. You divide both sides by 60,000. Okay, here you get 80,000 divided by 60,000, 1.33 equals 1 plus g to the power 4. Then the way you get rid of this power 4, okay, you can either get the fourth root of 1.33 and the fourth root of this, or you can use indices. Remember, to get rid of that power 4, multiply it by 1 over 4. What you do on the left hand side, so do on the right hand side, same thing. Okay, this 4 will be cancelled out and you remain with 1 plus g here. Then this 1.33 to the power 1 over 4, which is the same as the fourth root of 1.33, will give you 1.0745. And then just to get g, you just take this 1 over the equal sign and you subtract. Okay, colleagues, can you get me? Hello? I was kicked out. My band was finished. Where was I kicked out from? Where was I kicked out from? I was explaining the third way of getting our growth rate. The third way of getting our growth rate, right? We already tabulated the dividends. Current one is 80,000. The dividend for 4 years ago, 60,000. Okay. So if you multiply this 60,000 times the growth rate to the power 4, since it's 4 years, you're supposed to get 80,000. So you just set up an equation where you want to find g. Okay. Set up an equation where you want to find g. Okay, and the first thing that you need to do, you get rid of this 60,000 here by dividing both sides by 60,000. There you're going to remain with a 1.33 equals 1 plus g to the power 4. Now we need to get rid of this power 4 so that we remain with a g by itself. So you multiply both sides powers by 1 over 4. Okay, because you want to get rid of 4, so that's why I'm multiplying by 1 over 4. What you do on the right hand side, you do it on the left hand side. Okay. Yes. So multiplying both sides by the power 1 over 4 is the same as getting the fourth root of 1.33 and the fourth root of 1 plus g to the power 4. These two operations are the same. Okay. You don't need to do both. Okay. They are both the same. Okay. You either get the fourth root of both sides, or you can either attach a power 1 over 4 on both sides. Okay. So when you touch a power 1 over 4 on both sides, you remain with 1.33 to the power 1 over 4, and then you remain with the 1 plus g. You've got rid of this 4. Okay, it becomes like this 1.33 to the power 1 over 4 equals 1 plus g. Okay, because we've got rid of this power 4 for g. And we saw 1.33 to the power 1 over 4. We said it's, what's this? 1.074 or 1.0745, depending on how you round it off. And just to get your growth rate, you just take this 1 over the equal sign and you get a growth rate here. 1.0745 minus 1, 0.0745, which is a growth rate of 7.45%. So colleagues, those are the three ways you can get this growth rate. Okay, you can either use this method where you say the initial dividends multiplied by the growth rate raised to the number of years should give you the current dividend and solve for G. Or you can, the dividend payout ratios, you can divide them and raise them to the power 1 over 4. Or the actual dividends, the current dividend and the previous dividend, which we tabulated, can divide them and raise them to the power 1 over 4. Any questions, colleagues? For those who have joined, we are doing part 3, where we're trying to value this company using the dividend valuation growth model. And this is the formula for the dividend valuation growth model. All right. So we already have DO, which is the current dividend that is being paid, which is this. Remember, our dividend payout ratio was 40% and the profits was 200,000. So the dividend that has been paid, 80,000. We don't have our growth rate and our cost of equity. So we've got our growth rate. Our growth rate is 7.4%. Then now we need to get our cost of equity. So looking at the information on the question, okay, we've been given an equity beta. So you know, just by seeing this equity beta here, okay, you know that, okay, cost of equity, I can calculate it using the capital asset pricing model, okay, which says the higher the risk, the higher the return, okay. We've been given the risk-free rate. What was the risk-free rate? Risk-free rate is 4%. Then this, the average market risk premium. Okay, if you look at the formula for the capital asset pricing model, it's the risk-free rate plus equity beta, open brackets, the return on the market. Okay, this is the average return on the market. Okay, if you invest in any security on that market, the return you expect is given by the average market return. So the average market return minus the risk-free rate. Now this average market return minus the risk-free rate is what we call the risk premium. Okay? It's just telling you the extra return you get if you invest in the riskier securities, which are the shares and the corporate bonds, as opposed to investing in government securities. Okay, that's the risk premium. It's just the extra return you get when you invest in riskier investments. Okay, so this RA minus RF, you don't need to subtract it. It's already been subtracted for you, 6%. Okay, so using the capital asset pricing model, here it is. Risk-free rate 4%, equity beta 1.82, market risk premium, this RA minus RF is 6%. If you want, you can convert the percentages into decimals, but I would advise just leave them as percentages so that your final answer is just as a percentage. Okay. So you do 1.82 times 6, you get 10.92%. This 10.92%, add it plus 4%, this is 14.92%, which is the cost of equity financing, or it is the return required by the providers of equity financing. This is the minimum return they're requiring. Okay, that's our cost of equity. Any questions? Before now we calculate the value of this company. Okay, so now we can calculate. Okay, as you can see here, the formula. Okay, DO is the current dividends that have been paid, which is 80,000. Okay, our growth rate, it was we said 7.4. Here in my workings, I used 1.3333. That's why I got 0.0745. So no need to worry. Okay. Then we have our cost of equity here. Okay. We put it under here, 0.1492 minus the growth rate. Okay. Then you add 1 plus 0.0745, you get 1.0745. Multiplied by 80,000, you get 85,960. At the bottom, 0.1492 minus 0.0745, you get 0.0747. And when you divide the two, 85,960 divided by 0.0747, you get 1,150,736.2 kwacha. So this is the value of NLC. In the question, I think there was a typing error because there was NLC and Trimble Limited. So we'll just use NLC. Okay, this is the value of NLC's equity. Okay, it's the value of the company based on its equity, 1,150,736.2 kwacha. Any questions, colleagues?